Picture this. You walk into a car dealership. A brand new car is gleaming under the lights. The salesperson walks over with a big smile and says, "Don't worry about the price. Focus on the monthly payment. It's only 15,000 rupees a month." 15,000. That sounds manageable, right? That's what they want you to think. Because here's what that salesperson does not tell you. By the time you've made every single payment, you will have paid nearly double the price of that car, and the car will be worth almost nothing. That's the installment trap. And today, I'm pulling back the curtain on all of it. Let's start from the beginning. When you buy a car on installments, also called a car loan, here's what's actually happening. You don't own the car. The bank does. You're renting it from the bank, and every month you make a payment that covers two things: a small piece of the actual car price, called the principal, and the bank's fee for lending you that money, called interest. Now here's the part that almost nobody explains properly. In the early months of a car loan, most of your payment goes to interest, not the car itself. The bank gets paid first. You get almost nothing. Let me give you a real example with real numbers. Let's say you want to buy a car that costs 3 million rupees. You pay 20% down, that's 600,000 rupees, so you finance 2,400,000 rupees at a typical rate of 20% per year over 5 years. Your monthly payment comes to roughly 63,000 rupees. Over 60 months, you'll make total payments of 3,780,000 rupees. Add your down payment, and the total cost of that 3 million rupee car is 4,380,000 rupees. You paid almost 1.5 million rupees extra just in interest. That extra 1.38 million rupees didn't go toward anything you can touch. No car, no asset, just the cost of borrowing. Now let's talk about something even darker. The dealership isn't just making money from selling you the car. They're making money from your loan, too. When a dealer arranges your financing through a bank, they typically get a commission, called a dealer reserve, for every loan they place. The higher the interest rate they get you to accept, the bigger their cut. So when a dealer says, "We got you a great rate," ask yourself, great for who? Dealers can often mark up the interest rate above what the bank actually requires and pocket the difference. On a large loan, this markup can add hundreds of thousands of rupees to your total cost, and you'd never know. Then there are the add-ons: extended warranty, paint protection, interior protection, gap insurance, credit life insurance. Each one sounds reasonable individually. Together, they can add 200,000 to 500,000 rupees to your total loan, often without you fully realizing it. The whole financing process is engineered to move your attention away from the total price and toward the monthly payment, because a small monthly number feels affordable even when the total is catastrophic. Here's the second punch in this double blow. While you're paying all that interest, the car is losing value every single day. Cars are one of the worst investments ever created because they depreciate, meaning they lose value the moment you drive them off the lot. On average, a new car loses 15 to 25% of its value in the first year alone. So let's go back to our 3 million rupee car. After 1 year, it might be worth 2.25 million. After 3 years, maybe 1.8 million. But you still owe close to 2.2 million on the loan. You owe more than the car is worth. This is called being underwater or upside down on your loan, and it is one of the most dangerous financial positions you can be in. Why? Because if your car is stolen, totaled in an accident, or if you need to sell it urgently, the money you get doesn't cover what you owe. You pay off the loan and you have nothing left. You're starting from zero, but now you're also in debt. Here's the real math. Car value after 3 years, 1,800,000 rupees. Amount still owed on loan, 2,200,000 rupees. You are 400,000 rupees underwater. If you sell the car today, you still owe 400,000 rupees and have no car. Okay, so what should you do instead? I'm going to give you 3 real alternatives, and I'll be honest about who each one works for. Alternative 1. Buy used with cash. The single most financially powerful move for most people is to buy a used car outright with cash. A 2 to 3 year-old car has already taken the biggest depreciation hit. You get most of the value at a fraction of the cost with zero interest payments. If you're spending 63,000 rupees a month on car payments, what would happen if instead you put that same money into savings for 12 months? You'd have 756,000 rupees. That buys you a very decent used car with no monthly payment forever. Alternative 2, the delayed upgrade strategy. If you already have a working car, even an old one, keep it for 2 more years. While keeping it, save aggressively. After 2 years, sell the old car for whatever you can get, add your savings, and buy a better used car with cash. Every 2 years, upgrade. No debt, no interest. Just discipline. Alternative 3, minimum loan, maximum down payment. If you truly need a newer car and can't avoid financing, at least minimize the damage. Put the largest possible down payment, ideally 50% or more, choose the shortest loan term you can afford, 2 years instead of 5, and never add extras like paint protection or extended warranties to the loan. Pay those upfront or not at all. Now, I want to be fair. There are situations where a car loan makes sense. Let me be honest about that. When is a car loan actually acceptable? When the interest rate is very low, ideally under 10%, when you have a stable income that comfortably covers the payment, when buying the car directly enables you to earn income, like a delivery driver or a small business owner who genuinely needs reliable transport to generate revenue, and when you put a substantial down payment and keep the loan term short. Even then, run the full numbers. Calculate every rupee you'll pay in total. Then decide if it's worth it. The mistake is not doing the math. Most people just look at the monthly payment and say yes. Here's the bottom line. Cars are tools, not trophies. The goal of a car is to get you from A to B safely and reliably. A 10-year-old Honda that's paid off does that job just as well as a new one that bleeds you dry every month. The wealthiest people I've studied don't drive the nicest cars. They drive modest, reliable cars because they understand that every rupee not spent on interest is a rupee building their future. Before your next car purchase, I want you to do one thing. Calculate the total cost, not the monthly payment, the total, every rupee. Then ask yourself, is it worth it? If this video saved you even one bad decision, share it with someone who's thinking about buying a car right now. Subscribe for more content that tells you the truth about money. See you in the next one.